What a day today. Isn't this fantastic? I hope everybody's having a great time and the weather is really cooperating. So let me jump right into this. John alluded to ETF and indexing really began with David, and you may know that Dimensional Funds was co-founded by David Booth in 1981, but you probably don't know that he helped to create the first index funds with Mac McCowan over at Wells Fargo. Why don't we start there? Tell us about the origin of the index fund.
Well, I mean, it was the outgrowth of some serious academic research. People don't realize, but before like about 1960, you really couldn't test much of anything with respect to investing because the data and the computers weren't there. But all that changed in the 60s, and one of the first things academics investigated was, is active management worth the cost? And that started a type of study that's been going on for the last 60 years and always ends up showing the same thing, that active management isn't worth the cost. So the question then became, well, what are you supposed to do if you're not going to be picking stocks and timing markets? The answer was, and for the life of me, we haven't been able to figure out who came up with the term index fund, but somehow, spontaneously, the idea of an index fund came up. Instead of trying to beat the market, track the market. And so that was it. And it was a way, the enthusiasm that was created because it was a total paradigm shift in the way people think about investing.
So you mentioned the academic research wasn't there. It makes me want to ask you about CRISP and how that evolved and your involvement with, hey, let's actually figure out what the data is and how these various stocks have performed.
Well, it's great if you have data, but you want to be very picky. You want to have research quality data.
High quality, clean.
Clean and without survivorship bias in it. That's the difficult thing. Stocks disappear. So if you look at a list, the New York Stock Exchange today, the stocks there will have all done reasonably well compared to the stocks as a whole. So you have to, anyway, there's it was the University of Chicago came up, funded by Merrill Lynch, a study that collected all the data from 1926 to 63, hand collected all the data, every stock, every month, every dividend, every split. It was a huge data exercise.
That never existed beforehand.
Hadn't been done before.
Like we take it for granted that you could 2 clicks get whatever you want.
Yeah, and you'd ask somebody, what do you think stocks return historically? What's been the return on stocks? You hear the goofiest responses, 15% a year up and down, or whatever, 2%. People didn't know. So it turned out the answer, that first study was 9.3% per year.
Wow, that's amazing. And you mentioned academics love the idea of passing investing, but I'm curious, when you first started playing with the idea of an index, how was that received by the industry?
It was blasted. People like Fama, who's my mentor, Gene Fama, and other academics, they were really poo-pooed by Wall Street. And I'd like to bring it up because people ask, why has indexing been so successful? It's because it worked. So it's, and eventually, I got called all kinds of names, like you describe somebody an index fund, they go, gosh, that's un-American. I go, what's un-American about that? They go, well, it's settling for the average. Well, it turns out the average stock does better than the average manager, so it's not settling.
Pretty impressive. Gerard, tell us about how you first got involved in DFA and what's your role like today?
Yeah, so I joined the firm back in 2004, had finished my PhD in aeronautics, so made the transition over to finance. And joined
PhD in aeronautics, like you're literally a rocket scientist.
Yeah,
rocket scientist.
At Caltech,
So in this neighborhood, more or less. So I lived down in Southern California for many years before moving to Austin. And got involved with Dimensional and got involved with David and Ken and Gene and all of the great academics that are associated with Dimensional, and worked on lots of different research projects over the time. And that evolved over time to running the investment team, and then more recently, about 5 years ago, with Dave Butler, becoming co-CEO with Dave Butler.
So let's talk about that. You're co-CIO and co-CEO. That sort of dual role is pretty rare in finance. How did it come about, and what are the challenges of that?
Yeah, I think co-roles in general, in particular for CEO, tend to be rare at many organizations. Dimensional has always had a team-based approach to everything that we do, whether it's managing money, whether it's servicing clients, and we take a similar team-based approach to how we manage the firm. And so I have expertise growing up on the investment side of the business. Dave Butler has expertise growing up on the sales marketing side of the business. And we take a team-based approach to managing the firm. So the co-role, we do a lot of them at Dimensional because we have good relationships with all of our co-workers. It's worked out pretty well for us, and I think hopefully well for our clients as well.
Right, 40 years later, over $600 billion in assets. So you're at a point now where you guys are not stock pickers. Instead, you're more of a systematic approach.
Right.
Tell us a little bit about the academic research that colors your view of what indexes should look like, what it's like working with a team of folks like Gene Fama and Ken French and all the other academics that are part of the big team at Dimensional.
Well, I mean, one of the fundamental questions is, do all stocks have the same expected return? And the answer is no. That's kind of where the research has been going. And there are threads, we call them dimensions or factors, that distinguish why certain stocks have higher average returns than others. I don't know if, actually, Gerard is the researcher.
Same question to you, Gerard. What?
Yeah, I think that, David hit on some great remarks earlier on about indexing and the benefits that indexing has brought to the investment landscape in general. And I think if you're after the market rate of return, it's probably not a bad approach. If you want higher than market rates of return with better risk management, it leaves money on the table. And so our viewpoint is, if you're going to deviate from the market, number one, you have to have a good sound set of research. David talked about the data that was available, and more data has been added over the years, that you can do academic quality research into which stocks or bonds have higher returns and which have lower, and then take some of the kind of ideas of indexing, broadly diversified, low turnover, transparent, low cost, but do it in an active implementation type of an approach. And that's kind of what we do at Dimensional. We want higher than market rates of return in stocks and bonds. And we think that we have an approach that you can live with when returns are strong or when they're disappointing. And so I think that's what we've been able to accomplish on behalf of clients over many, many years.
So the last time we did this live was at the University of Chicago.
Yeah.
We did a Masters in Business Live with you and Gene Fama. Tell us a little bit about what it's like to work with folks like Gene Fama and Ken French, and how you go from a 3 or a 5 factor Fama French model to actually turning that into a portfolio.
Well, there's a lot there. It turns out it's a little more difficult to manage money this way than you might expect. There's lots of details, keeping track of every stock. We buy about 12,000 stocks around the world. Mm-hmm. It's an administrative nightmare. So, yeah, in terms of working with people like Fama, it's really been amazing. If you look at the various directors we have for the firm and for our mutual fund, 4 of them have gotten Nobel Prizes.
So who are the 4? It's Fama?
Fama, Merton Miller, Myron Scholes,
Bob Merton.
And Bob Merton. Yeah.
Right. That's
senior moment here, yeah.
That's a murderer's row.
Yeah, murderer's row.
But it's not just those 4. You have a really deep bench of academics.
Yeah, it's all of our mutual fund independent directors are academics and have always been academics. And for a good reason, which is this is where the cutting edge research is coming from. It's not coming from Wall Street so much.
So it comes from academia. Gerard, how do you take a great insight from a professor who says, hey, it turns out quality matters? How do you integrate that into modifying a broad index?
Yeah, the term fintech comes to mind, and we've been doing fintech for 40 years before the term was invented. Right. And I think that it's how do you get all that data that David referenced about thousands of stocks around the world, thousands of bonds around the world, And then how do you serve it up to portfolio managers to make real-time investment decisions? To give you kind of a sense, we consume over 1 billion data points at Dimensional. And
A billion.
1 billion. And we use those for historical research, for ongoing portfolio management. And that becomes a operational and technology question that we've spent a lot of time, effort, energy in how do we improve on all of those areas. Because you can have a great idea that comes out of academia, but without good implementation, it's worthless. And so what I think we're real experts on is how do we identify the great ideas in academia, and then how do we make them come to life with absolutely superb implementation. And that's what we focus on, is the identification and the implementation.
So let's address the audience that's here. We have about 2,200 people participating today. About half, almost half, are advisors. Tell us a little bit about the tools that you guys have developed to help advisors manage their business and do their best work on behalf of clients.
Well, we have quite a few tools, and what really distinguishes this, though, is the close working relationship we have with the advisors. We really try to support their business, help them communicate with their clients. You know, we've learned over the years the difficulty of communicating these academic ideas, and we realize advisors have that same difficulty in talking to their clients. Actually, a tougher job than we have. Mm-hmm. So we work closely with advisors to help individuals through that investment process, dealing with uncertainty.
Right. There's a lot of complexity. A lot of the stuff is very abstract. Tell us what sorts of things you do to give those communication tools to advisors.
Yeah. I think David hit it spot on, which is first, how do you find the right words to explain these very complex concepts? Because what we do at Dimensional are sensible ideas well implemented. And it's how do you take a complex idea and make somebody see, oh, this is very sensible, and it's a sensible approach based in, good economic theory. But I would use something like, there was a lot of talk in this conference about direct indexing and how do you personalize, how do you customize. Kind of an example of a tool that we've developed in more recently is how do we take our institutional size and quality of managing money and actually bring that down to a much lower account minimum. Because direct indexing is more or less, here's a list of stocks, kick out some you don't like and do some tax management. That leaves money on the table in our view. How do you take what we've been doing for 40 years with managing money for institutions and now do it for lower account minimums? And that's a combination of the technology to communicate what's going on inside the portfolio, technology to communicate changes to the portfolio between the advisor and us, and then the technology aspect of how do you manage that day in, day out in a totally integrated way, whether it's the tax management, the ESG, the asset allocation, all of those things done seamlessly. So I think that there's this notion of, you mentioned the word complexity, which requires customization, but everybody wants it conveniently, the 3 C's. And I think that's something that we focus on, is how do we get solutions that can be customized to these complex scenarios, but very conveniently for the advisors we work with.
So we talked a little earlier about the FAMA French model, which really begins with value. A lot of questions about value. Let's start with the easy one, which is value's had a pretty good run recently following a period of underperformance. So first question, what do we think about value here in the middle of 2022?
I think it's a great idea.
Value investing.
Yeah.
So there was a lot of pushback to value over
Right.
the previous couple of years. How do you manage around that?
Well, I mean, part of it is just we kind of sell through education. And one of the things that you got to get people to understand is the variability of whatever conclusion you reached. It doesn't work all the time. When we started the firm, and all we had was a small cap portfolio, we were the first people to create a small cap.
Based on research from
Rothbond, the University of Chicago. And it turns out we started at the beginning of the worst 9-year run for small stocks versus large. You can't find a 9-year period where small stocks underperformed large as much as they did in our first 9 years. I mean, that's an ouch. In some ways, that's really the tease about the firm. How do you, confronted with horribly disappointing numbers, how do you grow a business?
well, how do you maintain your confidence in your academic belief if right out of the gate you have almost a decade of your strategy going against you?
Well, I mean, our pitch was really you ought to have large cap and small cap stocks. You shouldn't just invest all your money in large. And that's what we went out and talked to institutions about. And in 1981, large institutions weren't holding stocks of small companies. So, as the performance unfolded, and we had to, at first, you can turn the charts upside down and people think it's funny. But after 9 years, it's you have some.
That doesn't work.
Yeah, I remember one client grabbing me by the arm and saying, have things changed? Do you no longer believe that small cap stocks have higher expected returns than big cap? I said, no, nothing's changed. We think small cap stocks are riskier than large cap, and risk and return are related. What part of the argument are you no longer comfortable with?
Right. And what do they say?
He just turned around and went back into his office. I mean, these things happen, But and actually, that's a lesson for advisors out here. It's really incredibly important that you tell your clients what you believe. You got to believe something.
Right.
You just can't facilitate and say, I'll buy you whatever you want. You got to come up and say, here's what I believe, and whatever you believe is going through long periods of time when it's not going to work. And that's when you realize you have a business. If you can go through those tough times and keep your clients, then when you go through the great performance, I mean, that's a piece of cake.
That's easy.
Yeah.
Gerard, what do you say to people?
Yeah, we've had a great performance for value over the past couple of years, in particular after a few years when it wasn't so great. But going back to David's point of how to communicate, very simple graphic is value stocks have outperformed growth stocks on average by about 4% a year for the past 100 years. If I take the 25 worst years for value versus growth, in the following year they outperform by 4% on average. If I take the 25 best years of value versus growth, in the following year they outperform by 4% on average. So after a good run or a bad run for value, you actually have no idea what the next year is going to be, but the average has been about 4% here in the US. And I think that's the important point. I would build on what David mentioned is you have to believe in something and have a good philosophy that's sensible, because it will be tested and you will have time periods when that is disappointing. And if you make that change right at the worst time, like March 2020, you've experienced all the pain and you don't stick around for the upside. So I think that disciplined approach is critical, and having a philosophy is important to instilling discipline.
It turns out markets don't have any memory. Individuals do, but
Right.
Markets don't. So what happened yesterday isn't informative about what's going to happen tomorrow.
Mm-hmm. That makes a lot of sense, and that leads to a quote of yours: life is uncertain and so is investing. How should audiences think about this, and how should they communicate this to their clients?
Well, I think if I look at mistakes people make along the way, people spend too much time trying to think about what they think will happen, and they don't spend enough time thinking about what can happen. Mm-hmm. People come on financial news programs and give you a point estimate. I think next year, by the end of the year, I saw one this morning, the S&P will be at 4,500. Come on. I mean, you can't predict things accurately. You have a distribution of outcomes. Mm-hmm. So you always want to be looking at the distribution of outcomes and find out what works best, for the client.
Mm-hmm. That's interesting. Gerard?
Yeah,
life is uncertain?
Life is uncertain, but without uncertainty there would be no reward, right? I mean, that David says this many times. If there was no uncertainty, then we'd all be getting T-bill rates of return. And that uncertainty provides lots of opportunity, because why do people take risk with their money when they're investing? Because they can't achieve their goals for retirement or saving or whatever their goals with their money might be without taking risk. And that risk affords you higher returns over the long pull. And so my view on it is life is uncertain, but again, if you have that disciplined approach, that helps manage the uncertainty and provides opportunity for investors.
Yeah, we sometimes tell people, think about 25 years ago, mm-hmm. you were starting to invest. Can you forecast where you are today, 25 years ago? No. If I told you all the things that's going to happen in the economy over the next, from over the last 25 years. So I give you a cheat sheet. You're going to have, a Russian default. You're going to have the tech boom and bust. You're going to have the Great Recession. You're going to have, so on and so forth. Pandemic.
9/11 attacks, great financial crisis.
Now, if I told you that's going to happen over the next 25 years, would you want to invest in equities? A lot of people, when I do that, people go, they know I've snookered them. Because over that time period, a dollar invested in the market would have grown to $10.
10x.
10x.
Despite that parade of horribles, markets went up 10 times.
Right.
So what does that tell us about these headline news events? How should we incorporate those into our investment thinking?
You got to ignore them primarily. I mean, they're good for cocktail party conversation, but it's not meaningful in the sense you don't want to be trying to time short-term moves. With a high likelihood, that won't work. So let's say the last 25 years, that's pretty good return. So do you want to bet against the market? I mean, why would you want to bet against the market if you can get the market return that easily?
Yeah. So why did the market return such great results given all of those terrible events that took place?
Well, the market does a pretty good job of forecasting and adapting, and those are, on average, you would say, we have a tendency to think that mistakes are going to cancel out. So those are times if you were invested in equities that would have hurt. That was offset by the periods of time when things went really well, and the market does a pretty good job of handicapping all of that.
Well, it seemed like in 2020, markets sniffed out not just the vaccine, but the economic recovery, and eventually getting by the externality of the pandemic. We had a great year in 20. We had an even better year in 21. How should we be looking at this year, which started out so poorly for both stocks and fixed income?
Yeah, I mean, if you look at March of 2020, it started out pretty poorly for stocks and certain bonds in 2020. But to build on David's point, you had 10x over that 25-year period ending December 2021. If you had missed April, May, and June of 2020, you got 7x.
Really?
So it's all
That's
about
huge.
discipline. You could have lost quite a chunk of your assets by missing the three really good months because markets sniffed out all the good things that were potentially coming. So that discipline is really important. And I'd say the same in this year. It's been a rocky start to the year. We don't know what the rest of the year holds. But that discipline is incredibly important because prices have dropped to keep expected returns where people want them to be. So if they dropped, expected returns are still positive in the stock market, probably as a result of that price drop, but it's not a bad deal.
Actually, a favorite quote of mine is from one of our advisors. He said, I don't have clients with investment problems. I've got investments with client problems. So trying to educate people. It's always education, communication, education. If you get people to understand that there's an underlying order, it looks like chaos in the market, but there's an underlying order to all of this that works in your favor over the long haul. Once you can convince people of that, then they're likely to be able to stay in their seats and not miss out on those 3 months.
So we've had a regime change at the Federal Reserve. They're in an interest rate hiking environment. We have high inflation. What sort of advice do you give people in terms of here are all the big changes you should make to your portfolio for 2023?
Yeah, I would change the tense. We've had high inflation, we've had interest rate increases, and all of that is already built into stock and bond prices today. And when you look at the forward-looking stock and bond prices, there's nothing to suggest they don't understand that and are priced appropriately to give the required return that investors demand to hold those. So my viewpoint is always split the thing into two. One is your investment portfolio, and your investment portfolio can stay just fine the way it is. The other is your lifestyle. And there's a lot that you can say about maybe there's an oncoming recession, maybe inflation will stay high for some period of time. There's a lot that you can say about that. You may want to change your spending habits and so on and so forth if you need to do something that's activity. But all of that information is already built into your investment portfolio. So if you have a broadly diversified strategy that's built towards your risk tolerance, stay the course.
It's almost as if markets are efficient.
Almost.
Right? So I see we have a couple of questions coming up on Slido, and we'll get to those. I have just one or two more questions before we get to that. So use your apps, put some questions on Slido. So David, you've been doing this for 40 plus years. You look back at how you began and how the firm grew. You're now one of the largest providers of ETFs. Tell us about what you've learned over the journey. What do you know today that you wish you knew 40 years ago when you were first getting started?
Well, let me first off by saying one of the cool things that hasn't changed, which is this belief in markets and the ideas that led to the creation of indexing and led to the creation of our firm. We still believe those same ideas. Now, I've been out of school for 50 years. That's pretty cool if you can still believe the same basic stuff you believed before. Now, along the way, there's continues to be innovation, and I guess what I wish I would have known 40 years ago is what a dramatic change technology will make to the whole investment landscape, drastically reducing costs, creating easy access to information. Those are been difficult to forecast all of that when you're sitting there on a Selectric typewriter.
Right. Gerard, are we done with technological innovations affecting investing?
I don't think so. The last chapter in finance will never be written because there's always going to be innovation, new data sets, new markets, new instruments. And our job when we're servicing our clients is to figure out how to use those innovations to help them solve their problems as efficiently as possible. There's never been a better time to be an investor than today. To David's point in terms of prices dropping and the availability and access that you have to different markets today. So my viewpoint is that there's still more to be done, and I think that in 20 years' time we'll look back and see even better solutions for the end investor than we have today.
So one of the questions that just popped up is related to something I was going to ask. Are mutual funds toast? But really the better way to ask that is, are we going to see mutual funds get overtaken by ETFs? You guys just unrolled a lot of new ETFs. Tell us about the thought process that went into it. What led you to say we need to embrace ETFs after essentially being a fund company?
Well, actually, Gerard led the way on that. I'll just comment that, we have mutual funds and ETFs that do the same thing, similar things. It's just that you can think of as being different wrappers. An ETF is a wrapper, straight mutual fund a different way. Some people, I still invest in our old mutual funds. Other people find the convenience of ETFs. They like that.
Everybody's 401k are all mutual funds, right? You don't need the tax advantage of ETFs. Tell us a little bit about the thinking that went into the ETFs, and what else are you thinking about in that space going forward?
Yeah, there was two big drivers. One was change in regulation that allowed us to do in an ETF wrapper what we had been doing for many years in funds. Because when you looked at the ETF landscape prior to 3 or 4 years ago, it's 95+% index-based approaches. Mm-hmm. And we wanted to bring something that was kind of true to our investment philosophy and mutual funds to the ETF space. The second was advisors' use of ETFs and their basically demand from us to say, we want something similar to your funds, but in an ETF wrapper because we use both. Are funds toast? Who knows? I don't think that's a bet any of us have to make or a forecast we have to make, because regulation can change overnight to give an advantage from one vehicle to another. And platforms can change overnight to change how they charge for commissions and all of these types of things, and that can change the landscape. My viewpoint is that we should have one investment philosophy that we can communicate and articulate clearly to the advisors we work with, and then choose your own adventure. You want our ETFs? Great. You want our funds? Great. You want our SMAs? Great. We got no problems. We can deliver the same high-quality investment proposition regardless of the vehicle. And if we can do that, we don't have to make the call about which vehicle will be the most popular 10, 20 years from now, because we'll have all of those available to advisors. And to David's point, some vehicles will suit some clients better than other vehicles, and that's okay.
So one of the questions that came up is, what should advisors tell clients who say, hey, I can now get these same sort of ETFs that used to be only available as a mutual fund through an advisor, through an ETF? How do you respond to that advisor?
Well, I mean, we basically are still selling the same way we always have, which is through seminars and so forth. And individuals aren't invited to those things. So we're not really selling to individuals. Yeah, they can buy it. And I think for the advisors, it'll turn out to be really a good deal that we have ETFs, in that who buys the ETFs? It's typically somebody that doesn't have enough money to have an advisor, and they get into the ETF, and hopefully by starting in that part of the life cycle, then that can feed into working with advisors as their assets accumulate.
Are you guys finding advisors are using your ETFs in their non-qualified accounts, in their taxable accounts?
Yeah, absolutely. I mean, our viewpoint is that we're here to support the advisors, and we haven't changed that mantra at all. And when you look at our ETFs, they were built to support the advisors. And so the predominant user, because of David's point that we're interacting with advisors, we're doing educational seminars, we're building tools to help them navigate their businesses, that the predominant users are the advisors that we've worked with, and they use our mutual funds, they use our ETFs, and we're fully in support of that. And for advisors, I mean, the value of advice can't be understated. I have an advisor, even though I understand what asset allocation means and what I can do with my portfolios. The value of advice in terms of how to structure your overall investments and your trusts and all of those types of things, in our view, money manager, advisor, and client, that Holy Trinity is important, and we stand behind that 100%.
Final question before we wrap it up. Oh, here's another question, so I'm going to hold off the final question. I already know the answer to this, but I'll ask it anyway. Will DFA ever consider adding crypto exposure to its funds? What are your positions on crypto in general?
So crypto, I mean, it's a fine technological innovation, and there may be more currencies in the future, but I look at it as a currency, and currencies generally aren't investments. They don't have positive expected returns because it's not generating cash flows for you in the future. If you buy something with the hope that somebody else will buy it from you for more money, but it never generates cash flows while you own it, that's not an investment. Now, there's some cryptos where you can loan it out and get some interest rate on loaning it out, and then that turns it into a risky investment. But if cryptocurrencies become more and more popular and more adopted, I'm sure they'll find a place in kind of the more standard financial markets, and then they'll find a place in dimensional portfolios.
So our final question is, you and I have had conversations offline and previously, and I'm always struck by your discussion and your view of human innovation, ingenuity, and entrepreneurship. Tell us a little bit about that. And listen, the past couple of years have been kind of rough in the country. Politics is crazy. The pandemic is nuts. Inflation is crazy. What is your views of the future of America and the future of investing?
Well, I'm based on the way our view of markets and stuff, we're always optimistic and think that if you build portfolios taking advantage of these ideas, low cost, risk control, so forth, over the long haul, it's reasonable to expect you'll have a good retirement. So these tools are useful. I mean, it's important. We're trying to make lives better. That's the goal at the end of all of this. Now, sure, there are going to be bumps along the way, but what this investment thing is about is people. The basic assumption here is that people want to make their lives better and the lives of their family better. So when they hit a bump in the road, they just don't take it. They try to figure out how to get back on track, and that's what makes the whole. Multiply that across all the companies and all the people in all the companies, and that's let's call that ingenuity. That's what's really saving our bacon all the time. If you look over historical rates of return over long periods of time, stocks have done 10% a year, give or take a little bit. That's staggering when you think we had a Great Depression, a couple world wars, and still the long-term numbers come out in a sensible way. I mean, I can't help but be optimistic, and so I'm not so optimistic about politics, but in terms of investing, you're going to be okay.
That's great. Let's hear it for David Booth and Gerard O'Reilly.